Hi, guys. It's Dr. Robinson. It is the January 27th, 2023 meeting of the Money Masters Investment Club. This meeting was supposed to have been done live. I'm not sure what happened in terms of you guys not getting the links, but really nobody got the link and showed up. So I'm going to go ahead and post this meeting as our normal recording, but I will make sure that proper links are sent out for the next meeting. Remember, we do a live session the last Saturday of every month. Having said that, let's kind of go into our normal routine. First thing we're going to talk about is our itinerary. Nothing special here. We're going to do our financials like normal. And then because it was the last Saturday meeting, this is typically where we do some training. So I thought we'd do a little bit of training. So we'll do that at the end. Nothing significant, nothing too long. So this is our financials for the week. Previous NAB on 1/20/23 was 24.84. Gains for the week, 58 cents total. Ending NAV at 25.42 for a gain of 2.33% for the week. Overall, pretty good week, given where the VIX is at and what the market's doing. I'm also kind of using we're getting more comfortable with some new charts we developed over the last month or so, and I'm pretty pleased with how they're working. So I probably will start increasing the number of contracts we're buying. Right now, we're typically on average buying 500 to 1,000 at a time. Probably going to increase that kind of going forward. Our strangle, because the market's kind of ambivalent right now. There's no real clear direction to the market. Our strangle is kind of sitting where it's been. So we have lost a little bit of money. I'm sorry, gained a little bit of money on the calls from our previous month. So they're out of the money right now by $1.84. The puts are in the money by 336. Net unrealized gain right now 219,574. Not a whole lot of progress here because the market just seems to be stalled. So we're kind of hoping that the market breaks either way. I prefer it would break down and go to the downside. But in any event, with a strangle, you don't really care which way it goes, whether it goes up or down. I just prefer it to go down, the market to go down, because that'll raise the VIX a little bit. But at the end of the day, we're doing okay there. We're kind of treading water, not really improving any which way. So we'll kind of play that one by ear and see what the future brings. We do remember we have in the next week or so we've got the Fed meeting. I still think that it's 25 basis points. There are some rumblings out in the economic world that it could basis points move. I don't think that's true, but we did get a lot of positive economic news especially the last 2 or 3 days. It's been surprising how good it is, by the way. We got some GDP numbers. GDP numbers were solid. If you looked inside the GDP numbers, they were horrible, but you can't argue with a 2.9% GDP rate. So I'm not sure how to take it yet. Some of the numbers inside the GDP were horrible, mostly sales for the first time. Normally, when sales go down, GDP will go with it. But for whatever reason, actually, we know the reason. It was mostly inventories. Inventories were a lot higher. Now, inventories add to the GDP, but remember, inventories are things that have been made but haven't been sold yet. And that's something that's kind of pros and cons with it. It's good for companies to be making stuff, but it's not good for them not to be selling it. Because at the end of the day, if their inventories get too large, they're going to have to cut back and they'll start laying people off. And we're starting to see a lot of layoffs anyway. So some of the numbers inside the GDP were not great. Others were really good, especially the inflation numbers came in much lower than we expected. But I still think there's some downside risk to the market. But really, excuse me, the February 1 meeting of the Fed will be the tell on whether the market wants to kind of push higher or if it's going to start struggling to go back down again. So, having said that, hopefully in the next week or two, we'll start to see our triangle move one way or the other, and try to make or try to get those numbers to spread apart a little bit more. That's all I had for the normal stuff. So let's kind of do some, that last Saturday of every meeting or meeting of every last Saturday is designed to be a training session. So what I thought we'd do is just spend a couple of minutes on how to fix a trade. So every once in a while, we do get into a trade that goes the wrong way, mostly because we got into a head fake. It's also possible there's other reasons for needing to fix a trade that aren't necessarily connected to being on the wrong side of a trade. For example, sometimes news hits. You might be, let's say, for example, you're in calls and then something bad happens. I remember years ago, and a lot of you have heard the story. Years ago, I was in puts, just happened to be in puts. The markets were, my charts were going down, so I was in puts. And then, without knowing anything, there was an earthquake in Japan, and I didn't know about it for about 15 minutes. But all I knew is that my puts were going down like crazy. I was making a ton of money for my clients and stuff. So it was a good thing, but I didn't understand why. Um, Once I found out what the news was, that was a good thing. Now, pretend like you're on the other side of that trade. If you were in calls on that day, because maybe you had a different set of charts, and you're in calls, you got hammered, and you might have lost millions and millions of dollars if you're on the wrong side of the trade. So every once in a while, we get on the wrong side of the trade either because we fell for a head fake, or there was some news that came out that kind of, we call it exogenous risk. The exogenous risk came in and kind of wiped out our position. So we've got to be able to fix a trade. So what we're going to do today is really quickly talk about how to fix a trade, the best way to fix a trade, so that we can get ourselves out of trouble. So the best way to fix a trade, or the most common way, is to strangle a trade. So, and we've talked about strangling a lot. Now, when we talk about strangling a trade, the word strangle, it kind of conjures up a certain thing, but some people call this collaring a trade. It's kind of like putting a dog collar on a dog's neck. And all the collar is designed to do is kind of protect the position from going away from you too far. So if you got a dog on a leash, the dog can no longer get any further than the length of the leash from you. So, and that's effectively what we're doing with a strangled trade. So we're going to strangle a trade whenever we're on the wrong side of a trade, and we've got to try to fix that trade before it gets too far out of the money. So strangling a trade occurs when an investor is on the wrong side of a trend. This can happen for lots of reasons, and I just talked about some of them. But no matter the cause, it's critical to fix a trade before the trade gets too far out of the money. So what we want to do is we have to kind of make some quick decisions about, should I hold, should I strangle, or should I just go ahead and take the loss? Sometimes the better part of valor is taking the loss. Now, I'm not a big fan of taking the loss if I can avoid it. If the loss is minor, okay. But on the other hand, when you're dealing with 500 to 1,000 to even maybe 2,500 or even 5,000 contracts, there's really no such thing as a small loss. Even a 10-cent move on 5,000 contracts is $50,000. So I don't want to have to take those losses if I don't have to. So what I want to do is try to make a decision as quickly as possible about how to or when to strangle the trade. Let's look at some examples. This is a chart actually from Friday, so yesterday. So if you're in the position, and admittedly, this is a fast chart. I don't typically use fast charts too much. I do use a 2-minute chart only in the early morning, but I don't really make any decisions off the 2-minute. To me, a 2-minute chart is kind of an early warning thing. But a lot of people do use a 2-minute chart. So let's pretend for a moment that you're using a 2-minute chart on the day yesterday. Now, the green part there is the market going up. So you would have been in calls. That's an easy call. So you buy calls and you run them up and you've made a bunch of money. But you'll notice here, and this happens to be, and you can't see the times down there, but about 9:56 here, you'll see that, and I've got that circled in yellow, at about 9:56, this 2-minute chart wants to turn over. Now, the problem when the chart gets to a hill like this is we're trying to, we struggle sometimes to figure out whether this is what we call a recharge. Is this just simply the really short charts, the 1 chart, the 2 chart, kind of just consolidating a little bit and then they're going to push higher? Or is this an actual turn in the market and the market's going to now go down? If the market goes down, we don't want to be in calls anymore because we've already made a bunch of money in calls. So what we would typically do is get out of the calls and then buy the puts. The problem here is that sometimes when a 2-minute chart turns like this, there's no way to tell whether this is actually going to come down or if it's a recharge. So Since we don't know, let's pretend for a moment we just simply thought that this is a turn of the trend. So we go ahead and buy, and let's just do a practice trade here. We're going to buy 100 puts at, let's say, $1.25 at 9:56 p.m. Now, the cool thing here is if you'll notice that red line, that long red line there, that's how far down the puts went. So there was some money in there. The problem is it only lasted one candle, and this is a 2-minute chart. So during a 2-minute run here from right around 10 o'clock or so, maybe 10:02, this thing did run down, and you would have had 25 cents. Actually, I think the exact number here was 18 cents. You would have had 18 cents. Now, a lot of us, and we all make this common mistake, by the way, we all kind of get in our heads, oh, I want a round number, want the profits. So if we're up 18 cents, a lot of us simply would say, well, I'm going to wait for another 2 cents to get out at 20 cents. And that's going to be a great thing. But the problem is the market doesn't cooperate. The market doesn't believe in that kind of stuff. So you might be waiting for 20 cents and you're up 18 cents. And within the next minute or so, the next thing you know is that this thing has popped back up. And that's exactly what happened. By 10 a.m., so it went from, we get into the trade at 9:56. By 9:58, we're up 18 cents. But by 10 a.m., 2 minutes later, we're actually down by $1,200 or 12 cents. So this thing can move very quickly. So the question is now you're sitting here 12 cents underwater. What do you do about it? Now, what you could do is you could kick yourself for not taking the 18 cents or the $1,800 you had just a minute ago, or 2 minutes ago. You could kick yourself for it, but that's not going to solve your problem. You could also just go ahead and take the loss. Now, it's hard, and I'm the first to admit it, because it's the psychology of investing in the stock market. The psychology of it is, I don't want to take a $1,200 loss after I just had an $1,800 gain. Even though I didn't make the gain real, it's still an unrealized gain. But I hate being up $18 or $1,800, and then all of a sudden I'm down $1,200. Because then we start rationalizing in our head. It's just human nature. We start thinking, well, it's going to come back. It went down there for a minute. It's going to come back. This is just a recharge to the downside. That's where we get into trouble. We start outthinking things. So what happens here is the next thing you know is our charts turn back to green. So you'll notice our charts kind of went back to green, and now you're in trouble because this was a head fake. Now you know it's a head fake. So you've got just seconds to do something. Now again, the two most common things you can do is you can go ahead and take the loss and get out of the position and suffer whatever the loss is. Now, as this thing turns green, that thing is going up. So you might be down $2,000 by now, because you've taken a couple of seconds here to make a decision. So the next thing you know, you're down $2,000 and you're thinking, oh, I got to take the loss. And again, you don't want to take a $2,000 loss if you can avoid it. Or you can kind of come back and say, is this a head fake? Should I get in on the other side of the trade? Should I strangle the trade? And this is going to be the tough question. It's actually not as tough as you think, though. So to make a decision on what you're going to do, what you have to do is you have to have another chart up at the same time. You don't make all your decisions based on a 2-minute chart. We always want to have a little bit longer chart out there to kind of take out some of the noise of head fakes. Head fakes are just what we call noise. So the shorter the chart, the more noise you get in a chart. The longer the chart, it ignores the noise. The problem is if you have a chart that's too long, it ignores all the noise, and you can be on the wrong side of a trade for a long period of time after there is a turn. So sometimes you got to understand where the happy medium is between a short chart with a lot of noise and a longer chart with a little bit of noise. So what we're going to do here is we're going to look at another chart or kind of scroll down from here. But for the moment, what we've done is we've taken some puts. We were up $1,800 at one point. We didn't get out for whatever reason, and now we're $1,200 in the hole. What do we do? So what we have to do here is we have to confirm what the trend line is. So it's critical. What is the trend line? Is the trend line turning down like we thought? And this, if it comes up a little bit, it could be just a momentary thing before it comes right back down? Or is the trend really still to the upside? That's what we have to decide. So to do that, we need to view a longer chart, say a 5-minute chart. So let me show you a 5-minute chart. So this is the same chart, by the way. It just is 5 minutes versus the 2. So you can see in this 5 minute chart, we didn't see any of that movement down. Now you can see where it did go on this green candle here. So right where that yellow arrow is pointing, you can see that there was a downward move in the market, but the 5 ignored it. The 5 said this is just noise, ignore it. So it's actually safe to ignore. So what you would do is, now that you've confirmed the actual trend of the market and that the market is trending up, and it's actually trending up until right around 10:10. So this market was actually going up until 10:10. So you wouldn't have wanted to do or shouldn't have done any puts prior to 10:10. At 10:10, it would be safe to do puts, but not until then. So at this point, you've confirmed what the actual trend is. So the trend is to the upside. So what we're going to do now is we're going to strangle the trade. Now, to strangle the trade, we take the opposite trade. So we were in puts. The opposite of puts would be calls. So we take the opposite trade, or calls, but the funny thing is we're not going to buy the same number of calls. We're going to double the number of calls. Now I have it at 2 times. You don't have to do 2 times, by the way. You can get away with 1.5. The fewer calls in this case you buy, the longer it's going to take you to get to break even. I like 2 because I only need the stock or the market to move half the distance to get me out of the trouble I'm in. For example, let's say I was down 20 cents. Let's say at the moment I bought these calls, those puts were down 20 cents. Now it sounds like a lot, and it is. But if I buy, let's say, instead of 100 calls to compensate or to offset the 100 puts I bought, I'm not going to gather any ground or gain any ground on the position. But if I buy 200 of them, I only need the calls to move 10 cents to break even. So I don't need the calls to go that far because I've got twice as many calls. So what I do here is I buy 2. Now, Mike Harvey, some of you know him, he typically does 3. He'll buy 3 times the number of opposite position, whatever it is, calls or puts, but he'll buy 3 times. That's a good idea, by the way, because it will make him go 3 times faster in the direction that the market is clearly wanting to go. The downside is sometimes it is that the 5 didn't pick up on it sometimes, and occasionally, not often, but occasionally there is a downward turn, and now he's got 3 times the number of shares on the wrong side. But in general, if you keep the chart relatively short, in terms of, let's say, no more than a 5 to determine the trend, you should be okay almost 99% of the time. And he's become kind of a master at strangling a trade. But in this event, let's just do the 2 times. So now we take the opposite trade with 2 times the number of calls with at least a 50 delta. We don't want a really low. We're not going to do a straddle where we're going to get the same call that we had on the put. I want a different delta. So now keep in mind, because we're buying 2 times the opposite direction, it will cost you twice as much money as you originally put up, as your original position. So make sure you have adequate capital available to you. One of the things that I talk about with the guys every day when it comes to, are you going to strangle? If you're going to strangle, whenever you get into position, you need to make sure you got enough money in holding that you can use to buy an additional number of shares of options in case the trade goes wrong. So if you're limited in your capital, so let's say you only had, and I'm just going to throw a number out, let's say you had $25,000 in your account to start the day with, you don't want to buy $25,000 worth of puts because you've got nothing to strangle it with. So what you would do is you'd come along and say, well, what's half of that? And that, of course, would be 12.5. And then what's half of that if you need to buy it twice? I probably don't want to spend any more than $6,000 or $7,000 on the original calls or puts in this case. So I'd buy 6,000 or 7,000, but that would allow me to buy twice as many calls and still have plenty of money to place the trade and kind of get myself out of trouble. So always make sure you have reserve capital. Never go all in on a trade. I never do. Anybody knows how I trade. I never go all in on anything. There are moments where I don't leave myself enough money to do a full strangle if I needed to, but that's only because I'm on the correct end of a strong trade. And sometimes you just want to maximize your gains when you know that the charts are saying, the market's going this direction or something. So there are times where you can kind of get away from it, but in general, never get into a trade bigger than what you can strangle 2 to 3 times on. So let's go back to our 2-minute chart. So on the original position, it's on the left-hand side. So the original position, we bought 100 puts at $1.25 at 9.56. And now all of a sudden, here we are at about 10 o'clock, 4 minutes later, and the market is clearly going the wrong way. So the trend line was actually up, and we learned it from the 5-minute chart. So the trend line was up, and so we're on the wrong side of the trade. So what we're going to do is we're going to do 2 things. So let's go over to the right side. We call it the correcting trade. We buy 200 calls at $1.35 at 10 a.m. So now we have 200 calls versus 100 puts. So we're weighted, we have twice as much weight to the upside as we do to the downside. Now we're not going to sell right away. We're not on the puts that we originally had. Now remember, the puts are not working. They're out of the money right now. They're losing us money. So we do want to get rid of them because we're confident the trend line is to the top side. But we do want to make sure there's always that chance that something else could happen. So we hold on to them for just a few more minutes. But somewhere right around 10:02, we've kind of realized by 10:02, this market is in fact going back up. Now we go ahead and sell the calls. I'm sorry, and I got sell the calls there. It should be sell the puts. We go ahead and sell the puts. We want those off our books. Now that means we are going to take a loss. In this case, at 10:02, the loss would have been $2,000. So it's hard to take that plunge, but you got to go ahead and get rid of those puts and take the loss because it's actually okay. So we sell the puts at 10:02. Go back to the right side. We hold the calls until 10:10. You'll notice this 5-minute chart here said the market really isn't going up any further right about 10:10 or so. So at 10:10, now we can go ahead and sell the calls. So we hit the button to sell the calls. What's the result? Our result is we got a gain of a total gain of $6,000 on the calls. So we made $6,000 on the calls. We lost $2,000 on the puts. Our net position is a $4,000 gain. So we still made a bunch of money, even though we fell for a head fake and got on the wrong side of the trade. So at the end of the day, the whole purpose of a strangle, other than for the long-term stuff that we're doing as well, to kind of keep ourselves fully invested, the main part of a strangle is to get out of or fix a trade that has gone wrong. And again, it could go wrong for a lot of different reasons. It could have been you just fell for a head fake. It could have been news related. It could be some report that's coming out. Who knows what it could be? Maybe, I remember at one time a few years ago, there was a brief news thing that there were shots fired near where President Obama was at. And so you start thinking, oh man, this is an assassination attempt. And of course, that's going to freak the market out. So the market kind of spiked to the downside. Turned out had nothing to do with the president. It was just a shooting, a gang thing nearby where the president happened to be. So they cleared the area, got him out, and everything was fine. And the market kind of, breathed a sigh of relief and kind of picked up where it was. But for that 10 or 15 minutes that this was going on, the market was kind of in haywire. So those things happen, and we have no control over them. That's why we call them exogenous. They're just things that are beyond our control. So if you happen to get into something that's beyond your control, or if it is you fell for a head fake, strangle it and buy at the very least buy twice as many of the opposite direction, and you'll be good. And by the way, since we were already 20 cents down on the calls, I only needed 10 cents up. Like I said earlier, I only needed 10 cents up just to break even. Once the calls went up by 10 cents, now in this case they happened to go up quite a bit. I guess 60 cents or 30 cents on that, but I only needed 10. If the calls had gone up by 10 cents, and that's not hard to do, If the calls had just gone up by 10 cents and stopped, I would have been at dead even. I wouldn't have lost anything. I wouldn't have gained anything for the day, but I wouldn't have lost anything either. And now I can hit both sides. I can hit the buttons on both sides and get out. And now I haven't lost or gained anything for the day. It's kind of like a do-over or a mulligan. So at the end of the day, strangly is an important part of what we do. And it's something we use when we're on the wrong side of a trade. All right. That's all I have for you guys. So if you have any questions about anything, of course, you can email me, call me, text me, whatever it is. And other than that, we'll see for everybody on the calls. We'll see you on the weekly call on Monday. And then we'll go back to our normal recorded call next week. And I will make sure that the next time or our next live session, we get updated schedule. Everybody knows exactly what it is. I'm not sure what happened this time, but in any event, enjoy your weekend, and we'll see you next week, guys.